of the questions that come up frequently when advisors talk to clients and when we engage with financial advisors is, when is the right time to go offshore from a currency perspective? Should we wait for the rand to reach a certain level before we externalize money, or doesn't it matter? So with me today is Vongani Masongweni from the Research Hive at Momentum Investments and Marius Cilliers, Regional Manager at Momentum Wealth International. Vongani, let's start with you. Can you tell us a little bit about the Research Hive and your current role with them?
Thanks, Hugo. Hello, everyone. I'm Vongani, and I'm part of the Research Hive at Momentum Investments. And the Research Hive was established to strengthen Momentum Investments' long-standing research and evidence-driven decision-making culture and make it more accessible to all parts of our business. It's really the central hub that connects researchers, portfolio managers, and business teams, ensuring that insights and innovation flows across the organization for the benefit of our clients. Our work covers everything from reviewing and interpreting technology trends and client behavior to investment process and product innovation. While we focus on providing thought leadership, what's key is that our research is not research for the sake of research. It's research that helps improve our decision-making and ultimately enhances our client outcomes. In my role as a quantitative research analyst, I focus mainly on the investment side of the hive, applying data-driven methods to explore questions that help our portfolio managers make better allocation decisions and clients a clearer understanding of investment dynamics.
Okay, thank you for that. So you recently wrote an article a little bit about the impact of trying to time the currency and the impact of it on investment outcomes. Can you tell us a little bit about where that comes from? Why did that article come about?
Yes, and well, that comes from a question that we hear almost every time from investors and advisors, especially when the rand moves sharply like we've seen recently. People often ask, should I wait for the rand to strengthen before investing offshore? Or wouldn't I get a better return if I just try and time my entry? At the Research Hive, we wanted to test the idea using data rather than intuition. So we analyzed the rand-dollar exchange rate and its impact on global equity, bond, and cash returns from as early as January 1999 to May 2024. This is a long period that includes multiple currency cycles, crises, and recoveries, so perfect for the study. The first part of the study looked at quantifying what happens if investors are not invested in the right time and miss the most important currency days. In other words, those days when the rand either weakened or strengthened the most. For example, we simulated what a buy and hold investor would earn compared to someone who was out of the market during the top 5, 10, 20, or 50 biggest days of currency moves. This allowed us to explore a relatively simple idea. In real life, if you try to time the currency, you'll most certainly miss some of those key days. And so we wanted to see how costly that could be if your timing is wrong. In the second part, we went a bit further and tried to be a bit more realistic. We tested trend-following strategies that mimic different investor behaviors. We created 3 profiles, a conservative, moderate, as well as an aggressive strategy, each with different rules about when to shift money offshore based on how much the rand had moved over a 3-month period. We then compared those strategies to a straightforward buy and hold approach. The results were quite clear across all profiles. The active strategies underperformed the simple long-term approach. The more aggressively you try to chase currency trends, the higher the volatility and worse the outcomes. So the research essentially shows that while the temptation to wait for the rand level is understandable, the data doesn't support that behavior. Over time, staying invested in quality global assets and avoiding short-term currency calls delivers far more consistent results.
Okay, so what I hear is that trying to time the currency is not a good idea, and invest when you can, right? You mentioned some quantifying stats, etc.
Yes.
Can you give us a little bit more info on what it means when you miss the top performing days by trying to kind of time the currency?
Yes, timing currency can be quite costly. We already know that it's not a good idea, but there are costs associated with that, like a transaction cost, as well as if you miss the biggest or the biggest rand appreciation as well as the biggest rand depreciations. That can be quite costly. But then when we looked at the different approaches or strategies, whether you are a moderate and aggressive or a relatively more conservative trader, as you can see from the chart there, where we're looking at the effect on long-term equity returns, you can see that the long-term approach actually delivers higher performance with lower risk over time.
Thanks, Vongani. That really gives us a bit of a perspective of what this all means. I'm going to switch to you, Marius, and I want to get your take on it. So you engage with advisors, daily. What is your kind of take and experience on this topic when engaging with these advisors?
Thanks, Hugo. Yes, that question does come up regularly. And I usually get the sense when talking to financial advisors and clients that they get fixated on just what does the rand do. Instead of thinking about when I'm doing offshore investment for the long term, the rand is one component of it, but also got to look at the investable universe and also got to think about diversification. If you look at the chart on the screen, for example, you'll see the massive inverse relationship between what the market does and what the rand conversion rate is. And it's very, very difficult to get that timing spot on.
Okay. So you're faced with this question quite regularly, maybe the $1 million questions. Then how do you deal with it? What is your response?
It's always a different conversation, but I try and remind them that the rand conversion rate is only one part of the equation, right? Because if you do go offshore, you've got other things you have to think about as well. You have to think about, I'm going to externalize money, and then asset allocation really becomes something I have to think about. Then I have to think about the currency allocation. I got to think about that once I've decided on asset allocation. Am I going to use actively managed unit trust funds, or am I going to invest into passive ETFs? Or am I going to use a managed share portfolio? So I try and remind them that, the rand exchange rate is one component of the conversation, but where I invest my money into eventually is a much more important decision and drives long-term returns far greater than just the currency call.
So Marius, we've now heard both of your views. Do you still think that advisors or clients, they'd like to still control or have some sort of influence on the currency that they take, the currency exchange rate at which they take their money offshore? If that's true, what are the ways that you can actually influence it from an advisor or client perspective?
Sure, Hugo, it is still true. People do want some form of influence when it comes to taking money abroad. And generally, when they do take money abroad, they use an authorized dealer or a forex provider. Now, these forex providers have services that they do offer, and they understand the dynamics. So usually there's a conversation between the client and financial advisor in terms of what levels are we externalizing money, when do we pull the trigger, and what's our type of approach, because they do have their own expertise in terms of currency and research, and they always have a view in terms of when they want to externalize money. So I think that really just empowers the client and the financial advisor to have some influence and feel empowered that they were part of the decision in terms of when to externalize money. I think the other important thing is that once you exit the investment one day, you can of course also bring money back at different levels of exchange rate if you feel that's the appropriate thing to do. And once again, you want some involvement in terms of at what exchange rate, what is happening.
Okay, well, thanks, guys. Thanks for clarifying maybe some misperceptions that people might have on timing the currency. For me, no one has a crystal ball. I think invest when you can. As long as it kind of ties in with your needs, timing the currency just isn't the play.
If I can add one thing here,
Sure.
I think at the end of the day, I think we all agree, Vongani and myself, is that timing the currency is one part of the equation. Apply your mind, influence it as best you can, but all evidence suggests that over the long term, take the money out when you're ready to and invest, and the exchange rate won't be so prominent over a long period of time.
Thanks, guys. Certainly food for thought there. I hope that this conversation has equipped you with some insights to navigate the currency timing conversations with your clients. Marius, Vongani, again, thank you for joining us today. Enjoyed the conversation and appreciate your time.
Thanks.
Thank you.
Thank you.